Microsoft's massive AI investment, shifting consumer banking habits, and the evolving landscape of fintech regulation. These stories and more on Banking on Disruption Daily for Monday, the 6th of January, 2025. I'm Fred Caden. First up today. Microsoft is set to invest an impressive $80 billion into AI-focused data centers by fiscal 2025, targeting the development and utilization of artificial intelligence. This move, termed as a golden opportunity for American AI by Microsoft's Vice Chair Brad Smith, will see more than half of the investment funneled into the United States. Coinciding with Microsoft's plans, the demand for AI chips has significantly boosted Nvidia's market capitalization, marking it as 2024's largest global gainer. To support AI development, Microsoft also plans to train 2.5 million Americans in AI skills and emphasizes the importance of skilling programs. In regulatory news, the Federal Deposit Insurance Corporation has rated 5 banks as outstanding for Community Reinvestment Act compliance in its latest assessment. These banks include Truist Bank in Charlotte, Garfield County Bank in Montana, Matt McKinley Bank in Alaska, Open Bank in Los Angeles, and Spring Bank in Wisconsin. Meanwhile, Weimar, Texas-based Hillbank and Trust Co., received a needs to improve rating, primarily due to a less than reasonable loan-to-deposit ratio. The remaining 72 banks on the list, assessed in October 2024, were given a satisfactory rating. The Community Reinvestment Act mandates banks to meet the credit needs of their entire communities, including low and moderate income areas. Adding to our coverage, the Office of the Comptroller of the Currency is set to intensify scrutiny on larger financial institutions, with a particular focus on anti-money laundering practices. The OCC's semi-annual risk perspective emphasized the need for robust risk management frameworks amid the evolving banking environment, noting heightened operational risks and cyber threats. The OCC's roadmap for fiscal year 2025 focuses on intelligence analysis and strong authentication controls, especially in relationships with financial technology companies. In other regulatory news, the Consumer Financial Protection Bureau is intensifying efforts to halt illegal debt collection practices that target consumers at their workplaces. In a recent blog post, the CFPB highlighted its ongoing crackdown on companies employing aggressive tactics, citing actions taken in 2014 and 2018. The Bureau stresses that such practices can threaten employment and unjustly pressure individuals into paying debts they may not owe. With the prevalence of cell phones, the Bureau argues that contacting workplaces is often unnecessary and primarily aims to coerce or embarrass consumers. Shifting to the lending landscape. Vehicle sales surged to 15.9 million in 2024, up from 15.5 million in 2023. While lower interest rates help drive consumer demand, lenders would be cautioned that this momentum may not carry into 2025, particularly as potential trade tariffs could impact vehicle affordability. The recent growth in auto sales was supported by aggressive manufacturer incentives and normalized inventory levels, but financial institutions are preparing for a potential slowdown as consumer demand stabilizes and the EV tax credit faces uncertainty under the incoming administration. Finally today, many Americans who once hopped from bank to bank chasing better rates are now finding the minimal gains aren't worth the hassle of opening new accounts and managing different logins. For instance, a $10,000 deposit earning 4.85% annually would only net about $300 more over 5 years compared to an account earning half a percentage point less. Online banks are showing more resistance to lowering their yields as they rely on attractive rates to draw customers without the benefit of physical branch networks. While consumers have become more aware of their money's earning potential since the Federal Reserve's aggressive rate hikes in 2022 and 2023, the current environment has made rate chasing less rewarding, with some savers deciding that a difference of a few dollars per month isn't worth the effort of switching institutions. That's all for today. Thanks for tuning in to Banking on Disruption Daily. Until tomorrow, this is Fred Caden wishing you success in your digital pursuits.